The IRS has been on a win streak with cases involving 831B captives. In August of 2017, the IRS won the Avrahami case. In June of 2018, the IRS won the Reserve Mechanical case. And in April of 2019, the IRS won the Syzygy case. All of these cases have turned on the determination that the captive did not constitute insurance in the commonly accepted sense, and therefore the 831B election was invalid, and the deduction of the premium payments was also invalid. With this series of wins by the IRS, many 831B captive owners are questioning the operations of their captive and asking how to avoid similar problems. The key to avoiding problems is to only establish a captive for true risk management and business purposes. Moreover, the captive arrangement must include risk shifting and risk distribution. Finally, the captive must be run as a true insurance company. There are several items that the IRS will look at in making these decisions. First, if one of the goals of setting up a captive insurance company is to combat rising premium costs, then premiums to the captive insurance company should go down compared with those of previous commercial coverages. If the policies written by the captive include potential additional coverages that the taxpayer did not have before or could not afford before forming its own captive, the premiums could go up somewhat, but there should be specific written documentation of why those additional coverages are necessary and actuarial determinations of the premium. Second, the insurance contracts written by the captive must involve plausible risk. Third is that coverage must match a business need or risk of the insured. Fourth is that captive policy must be written as real insurance policies. This includes specifically showing how the premium is calculated. Policies that cover multiple risks should designate premium calculation by risk. Fifth is that the captive coverage should not be duplicative of coverages provided to the insured by an unrelated commercial insurance company. In addition to these items, the IRS will also look at how the captive is run, including whether the captive complies with the laws of the jurisdiction where it is incorporated, issues policies or binders in a timely manner, collects premiums on a consistent basis, has clear claims procedures consistent with insurance industry standards, and the insured files claims for loss events. Finally, the IRS will look at the captive's capital and whether it has sufficient capital to assume the risk of claims, whether the capital consists of illiquid assets not usually held by insurance companies, and whether the company has made loans or transferred the capital back to the insured. In short, the question becomes whether the captive has operated using standard insurance industry practices.